Welcome back. Today, we're diving into a valuation update that asks a huge question in the tech space right now.
Is Micron technology undervalued?
Exactly. The core of this material is whether Micron, at a $257 billion market cap, is in an AI supercycle or just facing the classic commodity peak fears.
And it really sets up that tension well from the start. It frames Micron against both its US AI peers and its Korean rivals.
Okay, let's get right into it, because that valuation gap is the foundation for everything.
Right.
The material points out Micron trades at a huge discount to, say, AMD at 28x forward PE or NVIDIA at 32x.
But at a premium to its direct competitors. SK Hynix is at 7x, Samsung at 10x, and Micron is sitting at 13.5x.
So there's this US premium that the piece attributes to lower geopolitical risk and better access to US capital markets.
Which is a good starting point, but I think that brings us to our first real opportunity here.
While that geopolitical reasoning for the premium is valid, it makes intuitive sense, the analysis really needs a more quantitative breakdown of the drivers.
Yes, the specific drivers that are offsetting the very real cost advantages that the Korean competitors have.
That's the weakness. Right now, the justification for a nearly 2x valuation multiple over SK Hynix, it just rests on these broad geopolitical ideas.
And a skeptical reader could just see that as, soft sentiment. It doesn't really stand up against the hard numbers of cheaper labor or existing scale in Korea.
So the suggestion is to strengthen that argument by linking the US premium to specific quantifiable benefits that are unique to Micron.
You have to turn that qualitative advantage into a real financial moat.
So for a concrete example, instead of just saying lower risk, you could quantify the benefit of access to US defense contracts.
Or controlled supply chains that just exclude foreign competitors. That's guaranteed revenue right there.
That's a great one. And building on that, you have to talk about the US CHIPS Act.
Oh, absolutely. Explicitly mention the impact of that funding or the tax credits on Micron's future cost of production.
It directly lowers their capex. It shows how that investment minimizes their long-term risk compared to producing overseas.
That's a tangible financial offset to the Korean cost advantage. It's not just a feeling anymore, it's a number you can plug into a model.
And maybe one more. The writer could analyze the impact of US export controls.
And how Micron's US designation gives it a distinct market access advantage.
Yeah, if Micron is the only approved supplier for certain high-security projects, that's basically monopoly power. That's worth a lot more than just a vague premium.
Right. Those three things, defense contracts, CHIPS Act subsidies, and protected market access, they transform the whole argument.
It moves from Micron is safer to Micron is financially advantaged by specific US policy.
A much stronger foundation for the thesis.
Okay, let's pivot to the second major point, which is the bear case.
So the bull case is frankly really strong. Micron's got 20-25% of the HBM market. They're sold out through 2026. Margins are going up.
That kind of visibility is it's unheard of in the memory industry.
It really is. But now let's look at the bear case that was presented here.
The argument that the stock is fairly valued basically rests on peak cycle fear.
The old argument. Memory is boom and bust. So this could all be a value trap if AI demand slows down.
And this is where we see a big structural imbalance in the piece.
I agree.
To counter that incredibly strong, specific, sold-out signal from management, the bear case needs to move way beyond historical cycle fears. It needs to introduce a specific near-term technological risk.
Exactly. The bull case is all about HBM market share and future bookings. It's very specific.
But the bear case is just generic. Peak cycle fear fails to address what's unique about this particular boom.
And so the generic argument that it always goes down eventually just doesn't hold up well against the concrete evidence of sold-out capacity for years to come.
So the suggestion here is to introduce a detailed technological risk factor that really challenges the longevity of their HBM3E dominance.
You have to force the reader to weigh a specific potential bad event against that current high visibility.
You could model a specific scenario, right? What if SK Hynix or Samsung actually leapfrogs Micron in HBM4 qualification?
Let's say in late 2026.
What would be the impact on margins if the current cash cow, HBM3E, suddenly becomes commoditized because the next generation is already out there and someone else is winning?
That is a much more potent risk. A single tech failure is way more damaging than a slow macro downturn here.
Yeah, and another angle, is there a risk in focusing only on HBM? It's exciting, but it might overlook a potential oversupply in standard DRAM and NAND.
Which is still the vast majority of their revenue.
Right. A stronger bear case would model, say, a modest HBM success, but couple it with deep weakness in those huge commodity segments.
That's a much more nuanced downside scenario. Because if the standard DRAM market hits a trough, Micron needs a colossal win in HBM just to tread water.
And what about the cost of staying on top?
The capex.
Exactly. The writer should challenge the margin expansion thesis by suggesting that the massive increase in CapEx needed just to keep up with these rapid HBM changes might into those higher profits sooner than people think.
The development cycle is just burning through capital.
So those 3 points, the HBM4 leapfrog risk, the commodity weakness, and the accelerating CapEx, that creates a really sophisticated bear case.
It shifts the argument from history says a bust is coming to the very technology driving the boom could cause the next bust.
Which is essential when you're valuing a stock on its tech leadership.
So that brings us to the final piece, the conclusion where all of this has to come together.
The final conclusion in the material is very binary. It says, if you believe the AI boom continues for 2-3 more years, Micron is undervalued.
And if you think AI spending will cool off in 2026, the stock is probably fairly valued.
It sums up the conflict, but it sort of leaves you hanging.
That's clearly laid out. I wonder, though, if we've considered how much stronger it would be if it reframed that conflict.
How so?
By turning it into a quantitative threshold that justifies the valuation gap with its AI peers.
So the weakness is that the ending gives a conditional verdict, an if-then, but it doesn't give the reader a testable metric.
Exactly. It doesn't give them a required growth rate to watch for. It just gives a price target of $230 and an outlier of $338 and basically tells them to pick one. The reader has to do the final synthesis themselves.
Right. So the suggestion is to transform that conclusion from that simple if-then statement into an integrated framework.
A framework that defines the specific, measurable conditions needed for Micron to earn the right to trade more like an AI component stock.
Like an AMD or an NVIDIA.
Instead of a commodity cycle stock. Give the reader a North Star.
And we can be really concrete about this. For example, you could articulate the conclusion in terms of a break-even HBM revenue target.
Ooh, I like that. Calculate the exact multi-billion-dollar HBM revenue mix that's required just to bring the current 13.5x PE down to the 7x of its closest peer, SK Hynix.
Yes, that defines the floor. It tells the investor the absolute minimum goal Micron has to hit just to justify its current U.S. premium.
Or you could look at it from the other side and address the gap with the U.S. peers.
How would that work?
You could determine the implied revenue or margin growth needed to close, say, even half the multiple gap with AMD.
So to get Micron from a 13.5x to a 20x PE?
Exactly. That 20x multiple becomes a concrete, forward-looking milestone. It tells the reader, if Micron hits this growth rate, it should be re-rated.
That is highly actionable, and we don't even have to stick to multiples.
True.
Instead of PE ratios, you could frame it around market share durability.
Suggest a framework for monitoring if Micron can actually hold on to its 20-25% HBM market share through that really difficult transition to HBM4.
Because that HBM4 transition is the ultimate test. Is this a temporary lead, or have they built a lasting edge that actually warrants a structural re-rating of the stock?
By providing a way to monitor that, the analysis stays useful for years.
And by giving those quantifiable thresholds, the conclusion stops being a summary and it becomes a roadmap. It gives the reader tools to monitor the thesis in real time.
And that's really the difference between a good analysis and a great one.
So to sum up, this analysis of Micron's valuation is really well informed. It has a fantastic foundation.
But we've hit on 3 key opportunities to add a layer of quantifiable rigor that would just maximize its impact.
First, quantify those U.S. advantages. Move beyond general sentiment and use the CHIPS Act, defense contracts, and export controls to put a dollar value